Given that certain municipal issuers have the flexibility to raise revenues and cut expenses when necessary, issuer fundamentals are able to remain relatively stable.
While a sharp rise in yields in 2022 caused investors to experience volatility in fixed income portfolios, 2023 shaped up to be a much better year for bonds. Some investors view municipal bonds to be a comeback narrative in 2024, where managers can extract added value from fundamental research and security selection. Could you sum up key market dynamics as you see them currently?
So we're seeing some potentially seismic shifts in the muni market this year. One factor is the return of flows into mutual funds. The municipal marketplace of the last 2 years was largely driven by overall rate volatility rather than active security or credit selection. We believe that will change in 2024 as flows come back into the muni marketplace, supporting valuations. A second factor is recent shakeups in the asset management industry. If organizational changes lead to changes in muni manager behavior, opportunities from a relative value perspective will present themselves, concentrated in the high yield space.
Mike, what's your view on broad credit fundamentals, especially if economic growth is weaker than expected?
Well, in general, we think municipal issuers are resilient. Revenue streams among state governments are diverse, and when you look at reserve levels, we've seen broad-based replenishment of rainy day funds as municipal revenue collections hit an all-time high last year. In terms of credit quality, if you compare municipal ratings with corporates, for example, over the COVID pandemic, we didn't have nearly the number of downgrades in our market. Given that certain municipal issuers have the flexibility to raise revenues and cut expenses when necessary, issuer fundamentals are able to remain relatively stable. I think that holds true whether you're looking at investment grade or high yield credits within the asset class.
Yes, so looking at high yield, earlier this year, Mackay Municipal Managers changed our asset allocation model for the average moderate investor to call for a slight overweight to high yield at 70-30, rather than 80-20, which is considered neutral. What's the rationale for that?
Well, it's threefold. First, we think spreads in general are more attractive in the high yield space. Second, looking over the past 2 years, flows have yet to return in a substantial way, particularly in high yield. So we think a reversal in high yield fund flows will benefit high yield municipals. And third, organizational changes among players in the high yield muni landscape may include changes in their strategy and philosophy. This may change the types of bonds they're going to buy. For example, in recent years we've seen a tendency to chase yield. If somewhat indiscriminate buying turns to relatively indiscriminate selling, that could create some attractive relative value opportunities.
Now, turning briefly to taxable munis. This asset class that's really coming into its own, both for domestic and international investors. Do you mind describing the current opportunity here?
We expect to see institutional demand rebound this year, especially from international buyers as yield curves normalize and some of the currency hurdles in terms of hedging costs diminish. If you look at the kind of yield levels available at the beginning of the year, taxable munis offered attractive yields compared with the past decade, with competitive credit spreads and better quality than you would typically find in corporate bonds. Overall, we think municipals remain a very strong late-cycle asset class solution. The shifting market landscape requires investors to be flexible, but those seismic shifts also offer potential for attractive relative value opportunities for fundamental security selection.